So in this video, I wanted to talk about a no-risk trade that you could do with options. So this option trade is actually called a caller, and I'll give you an example with, I don't know, let's say Netflix. So you can look up caller over here. It's the last one on the list, and let's go to January 2025. Sorry, January 2024. So 386 days away. So if you look at the 290 caller, for example, the strike 290, you can see that it's worth 270, between 273 and 277. So let's say 275. So the 290 caller is worth 275. What does that mean? Well, let's click on it and see what a caller is. What are the components of a caller? So you can see a caller is buying 100 shares, selling one call, and then buying one put. This trade basically protects you from any risk whatsoever. Why? Because if Netflix, let's say, I'll get to evaluate an option trade, I like to give myself worst case scenario. So worst case scenario, let's say Netflix goes to zero on January 2024. At expiry, Netflix is at zero. So the shares you bought will be worth zero. Or first of all, to enter the trade, this is how much you're going to pay. You're going to pay $275 to enter the trade. Let's say at expiry, Netflix goes to zero. Your 100 shares is worth zero. Your call is worth zero. But your put, which is at a 290 strike, is going to be worth 290. So from this trade, if Netflix goes to zero, you're getting back $290. But you only paid $275. So even if Netflix goes to zero, you're making $290 while you paid only $275. So your return will be, in that case, 290 divided by 275. So you're getting a return of about 5.4% in 1 year. The short answer is, regardless of the scenario, you're making a return of 5.4% return guaranteed, no risk whatsoever. And that's why this is a no-risk trade. Now, ironically, this is almost the same rate that you will get in a GIC at the bank. So some banks right now are offering GICs for 1 year and offer about 5%. So a little bit less. But I don't think it's a coincidence that to get a 5% GIC, you're able to get this option trade on the stock market that gives you the exact same return. To continue with our scenario, if let's say Netflix is at 500, while your shares are going to be worth 500, your call is going to be in the money by about $210, and your put is going to be worthless. So the loss on your call of 210, because you sold it, so you're gonna have to buy it back for more. You're gonna lose 210 on your call, but you're gonna make an extra 210 on your shares. So it cancels each other out. You're left with the initial 290, and then you only pay 275 to enter the trade, and that's how you still make that same return of 290 divided by 275. Now, let's see if we get the same return regardless of the stock. Let's try on the triple Qs, for example, if you want to do an ETF. And we're going to look up the caller, and we're going to do 1 year out. Again, January 2024. We're going to go at 260 strike, for example. You could see right over here, it's trading at around 249. So 260 divided by 249 gives us a return of 4.4%. But at least the triple Qs probably pays a dividend. Let's see how much dividend it pays. Triple Qs, if I look up triple Qs here, it pays a dividend of 0.81%. So if you add 0.81 to this, it's going to give almost 5.5%. So it's the same thing. Let's try the SPY. I think the dividend on the SPY is a little bit higher. So dividend on the SPY is 1.66. So let's look at the caller trade on the SPY. So caller trade on the SPY, same thing, January 2024. Caller trade, we're going with 380, 344. So let's just say 380. So it's about 360, between 363 and 369. So let's go with 366. So we're going to do 380 divided by 366. So it's a return of 3.8, but you're getting a dividend, an extra dividend of 1 point something. I already forgot, 1.66. So it comes out to the same thing again. Let's try Intel, a stock that pays a dividend, I think, of 5%, INTC. So Intel pays a dividend of 5.63. Now I'm thinking this one will not have any return on the caller. So let's look at it. So INTC caller January 2024. But if it does have a return, then that's pretty good, because you'll get 5% dividends and 5% return. So that's 10%, no risk. So let's look at the 25 strike. Yeah, as you can see, it's there's no return. It's you're getting what you're getting. You're basically paying what the caller is worth, the strike of the caller. So 25, yeah. So there's no return here, really. Funny how markets work. So yeah, so if you don't want to do GICs at the bank, you could do the equivalent with the caller on the stock market. The only advantage I see between this and a GIC at the bank is if you don't want to wait a year, you could do the equivalent on a shorter term. For example, if I go back to, let's say I do Tesla. So if I choose Tesla and I do a caller, and let's say I don't want to do, first of all, let's see what the January 2024 return is on Tesla. It should be the same thing. So let's do 120 divided by 115. So 120 divided by 115, so it's about 4.3%, so it's not as high. But let's say I wanted to do 6 months only. So let's say I go to June, I could probably get a decent return as well, or probably half of that. 120 divided by, I don't know, 118.5, 120 divided by 118.5. So it would give me about a 1.2% return, no risk. Not really worth it. But also, it's probably using 122.84 in this calculation, because after hours, Tesla's trading $1 higher. So to be more accurate, let me look at the components exactly. So if Tesla's at 121.82 and I'm selling a call for 25.55 and I'm buying a put for 21.3, so it gives me 117.5. So the real return is actually 120 divided by 117.5. 120 divided by 117.5. So it's about a 2.1% return in 6 months. Now, what's interesting though is if you can find a way to borrow money for less than that, then you can make yourself a guaranteed return with absolutely no risk without even using your money. For example, there are credit cards that offer balance transfers that give you, I don't know, like I have one that has a promotional rate of 2% interest with no balance transfer fee. So just a 2% yearly interest, but it's only good for 5 months. So I would have to, if I wanted to take out money from that or do a balance transfer from that credit card, I'd have to stick with a 5-month trade. So let's say May 19, and then go with the 120 as well. Let's say on Tesla. Let's see what the return that would be. So Tesla's at 121.82. It closed at 121.82. The call is worth 23.85 and the put is 20.10. So 118.07. So return would be 120 divided by 118. So it's about a 1.6 return. But that's the actual return. It's not the annualized return. So it's a 1.6% return in 5 months. So annualized, that would be 4% return annualized, while I could transfer a balance from a credit card that's charging me only 2% annualized. So an easy, or not an easy, but a guaranteed 2% return on money that's not yours. But obviously, depending on the balance, it might not even be worth it. Like if it's $10,000, I mean, it's going to be, what, $200 if it's annualized, but it's only on a 5-month period. So it's going to be less than that. Might not be worth the headache of transferring the balance and making your minimum payments every month and then making sure to pay the balance in full at the end. But the concept or the theory is definitely interesting. I mean, to be exact, 2% annualized divided by 12 times 5, that's a 0.83% return. And we just said right now that this 5-month trade would return, forgot already. Let's do it again. 121.82 minus 23.85 plus 20.10 is 118. Okay, so 120 divided by 18. So that's the actual return, 1.6 and then it was 1.69, and I said the actual interest rate paid was around 0.83, so minus 0.83. So in a 5-month period, I can make a guaranteed 0.86% return, no risk, and using money that's not actually mine. Now, if it's $10,000, that's an $86 profit. But if it's I don't know, if it's $100,000, that's $860 profit. Now, I don't think I'd be doing this trade, but it's just interesting to know that there is a no risk trade out there with options, and it's funny that it's exactly the same return as a GIC at the bank right now. Even with Intel, although there's no return on the caller, but at least you're guaranteeing a 5% return from the dividends without losing anything on the shares. But might not be a good trade. If there's a stock that you're certain that they'll be paying the dividends, but you don't want the risk of capital depreciation, then you could do the caller on that dividend stock. You're guaranteed the dividend at least without losing anything on the capital, but you're also not gaining anything on the capital. So let's look at Verizon. It has a pretty high dividend. Let's say I'm concerned. I don't know if it's going to drop some more, but I like that it pays 6.65. And instead of going to a GIC at the bank, I want that guaranteed 6.65% return in 1 year. So I could go ahead and do a caller on Verizon. Let's see if it's going to cost me anything. So caller, January 2024. If I go for the 40 strike, as you can see, it's actually, I'm going to have to pay more. That's weird. Even the 35 strike, I'm going to have to pay more. Let's see the components. So 39.26, 315, and 465. Well, the put is worth more than the call. So I guess these dividends really are priced in. Everything is priced in. Because this is paying more than 5%, the caller is going to end up costing more because the call isn't worth more than the put. In all these other stocks, the call is worth more than the put. Not in this case. Interesting. So I guess the most guaranteed return you can make this year is 5% with a GIC at the bank. With no risk, of course. All right. Thanks for watching.